Hello everyone, today is another episode of Over or Under where we take a look at a stock and see if it's overvalued or undervalued. And today we will be looking at Adobe. And we can see that currently Adobe trades at $351.28 per share. Looking for the day, it's trading about even. For the week, up 1%, month down 4, 3 month down 11, year to date down 21%, 1 year down 34%, 5 year down 22%. Okay, so those numbers don't sound great, right? This is the kind of stock that is great to look at for valuation because the price is swinging quite a lot in both directions. And if you go by the whole Mr. Market hypothesis, it's that, when you're presented with swinging stock prices, you're given opportunity to find fair value and when you should be buying and when you should not be buying a stock, or if you want to short it, you can do that too. So this is a great stock to look at, and it's a well-known company. Generally, all I know about it in my personal experience is that when you open a photo, you can choose whether or not you want to click Adobe or another option for opening that photo. So I really don't use it beyond that, but we will go over some use cases in the afterward. So currently trading at 351, we can see a high in 2021 of 669. That's almost double the stock price, so it definitely brings valuation into question. We can look at some of these down here. We can see that there's a 67% buy, 31% hold, and 2.4% of a sell position. So generally consensus of 2/3 of the analysts is buy, and others say hold off a little bit, but there's little to say sell. So that means we're in a pretty good position, I'd say. We can look at the bull case and bear case here. Bull case says it's going to keep extending. They're going to subscription models. Removing high upfront costs for customers, so more customers can be acquired at that point. And they mentioned it's a de facto standard in work in the corporate world. That is true. Adobe is used quite often. In my experience, it's pretty much the standard. So they've kind of cemented their spot in the industry quite a bit. So I think, and we'll see some of this in the bear case, but I think they are in a good position to compete with others that are trying to take market share. So we can see largely built through acquisition, okay. Possibility of disruption from inadequate integration efforts, so maybe they're falling behind a little bit. Digital experience is an emerging space and one that Adobe neither created nor dominates. Growth can be slower than we anticipate, or margin expansion may not materialize. Okay, so this is saying there's competition, right? And this is true. We've seen this in generative models with generating photos, editing photos, making videos, whole movie films have kind of been discussed a little bit. And this is kind of in the realm that Adobe operates in. So it is a real concern, no doubt. But in my case, and I think I'll be the bull case for this one, I'd say that Adobe is a very large company and is poised to be able to compete with these companies because they have billions, while startups might have millions, and sure, they can IPO, right? And they can gain a lot of money that way. But Adobe has a great balance sheet, and they're able to put funds towards investments like this. And we'll look at their cash flow sheet, but I think the money they bring in states that, at least at this point, they can continue to compete and they can continue to invest in their own company. And if they do that, at the very worst case, they stay in competition. In that case, I would say it's undervalued. But in the best case, they blow out the competition and they really take ahead of the AI sphere in image generation and all the sorts. Or they can just piggyback off a model, quite frankly. I mean, they don't have to make their own model. They can use ChatGPT or Anthropic or something else that really, just kind of blows it out of the water in the image and video creation sphere. So that's kind of just where my headcanon's at with that. We can see that Morningstar says fair value is $560, and we're currently at $350, so quite a bit of margin there. I do like to see that it's not like closely undervalued, it's very undervalued looking at Morningstar. And we'll go in the report a little bit afterwards, but nothing too crazy. Recently, they've been beating on earnings every single time, which is great. So that means maybe there's more valuation out there that people are not quite seeing. And then there's some other stocks down there. So with all this in mind, let's look into the actual evaluation. Otherwise, we're just talking about numbers without any backing. So using our studio for some of this, we're looking at some key metrics here. We got revenue, operating expense, operating income, net income, earnings per share, and we're also looking at the growth rates of all of these because growth rate is really what matters. If they continue to grow, then that's where the value comes from. We can look at some charts down here. So first, in the black, we're gonna have revenue, operating expense in maroon, operating income in green, and then net income in blue. So what are we seeing here? Revenue is increasing, operating expenses are increasing. We would expect to see those increase together because as you scale the business, you should have more expenses come. Operating income is increasing, and net income is increasing. So they're all going up and to the right. So it gets a little difficult to come up with a consensus of where we're going with this. We'll look at growth rates, and that's going to help a little bit because all these can be growing at the same time, but it's how much they're each growing that we should be concerned about. So looking at this green color, we have free cash flow, and this is a very interesting free cash flow sheet. I'm not sure what causes this. I mean, it's clearly seasonality, so certain times of the year it does better, and maybe this is just annual subscriptions. That'd be my guess. But they clearly do have monthly subscriptions and quarterly subscriptions. As we can see in here, it's not just all dots at one point. There is a consistent way that it goes about. So maybe it's just at the end of the year, and we can see that these look like December's, November's. November's probably because that's what's reported. But we can see that's where the high revenue is. So maybe they do some subscription model based on the beginning of the year, or a lot of companies do their subscriptions at this time for tax reasons. It could be something like that. But nonetheless, we can see that November is the high period. So we can kind of look at the increase from the peaks and similar times of the year. And that's kind of how we would treat growth, because you can't really determine growth up and down like that. It's seasonal, so it's a lot different than something that might steadily be increasing. Okay, now let's look at some charts here. So in this first one, we're going to see revenue growth in black and operating expense growth in maroon. And we can see they're kind of working in tandem with each other, going against each other. So let's look at the difference here. So this is revenue growth minus operating growth, and all these numbers are quarterly. Keep that in mind. So as long as this number stays positive, that means revenue growth is outpacing operating expense growth, which is what we want to see. And we can see that generally, although it does, kind of tread water on the line there, it is in general going up, and we like to see that. Maybe we have an incredible down, an incredible up here. That might just be taxes. Honestly, a lot of companies end up reporting stuff like that, so that could be fair. But generally, it is trading above, which we like to see. And if you wanted to look at something a little more concrete, we have operating income growth here, and that is trading positive also, and that's what we want to see. We want to see their operating income, their income after operations, also be growing. So all that's good stuff to see. It's reassuring. I'd be more concerned if we saw this continually go down and that the company is struggling to keep up with margins and such. But this is looking pretty good. EPS, some people like to look at that. I'm not necessarily married to the number, but we can see that earnings per share has been going up and to the right. We like to see that, right? We want to see that each share that you buy becomes more valuable because you're earning more per that share. If this was going down, or even if it's trading even, that's a concern. If it's going down, it means they're extracting value, whether that's issuing more shares or earning less. If it's trading even, that means they're not growing, which is also a concern, because if you're not growing, you're dying. And that is a concern when it comes to companies like this, especially at their size and with their competitive issues that they're coming up with AI. So this is where the magic kind of happens, in my opinion. So we got two numbers here. First, we got revenue growth in green, and then we got a 3-month rolling average for revenue growth, which I like to look at when it comes to projecting for discounted cash flow models. So we can see revenue growth here. It's looking great. Obviously, we want to see it's positive, and apart from one instance here, it is positive consistently. So we like to see that consistent revenue growth. And I mean, we have some really good periods. That was a little bit of a tough period, but not nearly as good. So we have some really strong revenue growth. And then we have some pretty strong revenue growth. Very good, because this is by quarter, keep in mind. This isn't annual revenue growth. If this was annual, these numbers would be abysmal, and it would show they're in like a terminal phase, basically. But quarter over quarter, they're doing good. And we can see, if you look at this, this ends up being about 2.7 that they're ending at for the 3-quarter rolling average. So this is good, because if you analyze that and we'll look at that, it's going to be a little shy of 12%, I think. It should be a little bit over maybe, and then we're going to run a discounted cash flow model here. We got some code, fun to look at, not nearly as fun to code, but now let's look at the results of it. Oh, here we go. Okay, so now if we look at the discounted cash flow tool here, We're gonna have our ticker right here. Their current revenue, and this is in millions, is 22,601. So quite substantial. And now if we're currently at, so 2.7, and if we do that to the fourth power, we're going to get about here. I took the exact number from there. So this would be an annual growth rate currently based on rolling averages of quarterly growth of 11.63579%. So that's a very good growth rate. We like to see that. And we're going to say that it's going to grow at a high rate for 5 years. And then let's look at a long-term growth rate because they've sustained this growth for a while. I would say maybe 7 years. That's just a number I threw out there. I would normally say 5. That's just a basis. But quite frankly, they've held up this consistent growth for a while. So let's say that they are able to hold on to that better than other companies would. Let's put that at 7. And then we'll have that at 10 years. 7%, sorry. And then we'll have that at 10 years. So we're going to assume a longer time period there. And then we're going to have a perpetual growth rate. 3% is pretty industry standard for a perpetual growth rate. And this is just saying after those high growing periods, how long will this, what percent will this just continue to grow at in perpetuity or forever? And then looking at their free cash flow margins I found online, that's 36.51%. Very strong margins. So that's working in favor of it. Adobe is a high free cash flow margin business. And if we discount that at 10%, assuming that's what, the stock market about returns. And I looked at their shares outstanding, and in terms of millions, they have 424,200,000. So we'll run the discount cash flow, and we got the numbers already up here. What this says, basically, is that the implied share price based on these metrics is $515.84. So based on the revenues and the growth that we're assuming, they should be trading at $515. But currently, the stock is evaluated at $348.58. This would say that we're undervalued by $167.26 or by 47.98%. Now, what I like about this number is it's a lot of margin. It's not like we're undervalued by 20%, which is great in its own right and something we can look at, but we're saying we're almost undervalued by 50%. So that gives us a lot of wiggle room to use in our models. Let's say they had, 7 years of sustained growth. Okay, we're still undervalued. Okay, let's say the perpetual growth rate was 2%. Still undervalued. Okay, let's say they only grew at, something like 9%. Still undervalued. Okay, so they have a lot of room to fall short. And if they will fall short, I don't know. I would have to look more closely at the stories and all that. But they have a lot of room. They can have some market share taken from them, and they're still undervalued. So that's very good to see. They can grow at a slower pace, and they're still undervalued. So, and the growth periods can be shorter, and they'll still be undervalued. All these things. They're not constantly, decaying, EPS at the same time. They're constantly providing value for the investor. It's great things we like to see. So if we look at Morningstar, they're at 560. You can see the current price. So they're at 62% of their fair value price. They give them a wide economic moat, which is great. That's something we want to see considering that they're going to have a lot of competition. What we do see is uncertainty high, and that's kind of what we're getting at. We don't know the future. There's a lot going on when it comes to AI, and they're kind of in the middle of it. Capital allocation, exemplary. They have a lot on their balance sheets, and we'll go over that. So, we could go through a lot of this, but honestly, it's kind of what we already did. And if we scroll down, I believe they have, they're going to have their model here. Okay. So, they're assuming, let's see here, stage 2 growth of 9%. Perpetuity is at year 20. So they're assuming that it's going to grow a little more for a little longer, and that's how they get their higher valuation. But I would just be a little less bullish on it. Give us some more room. They do great in a lot of places. You can see they kind of constantly have high star ratings overall, but there are some fluctuating ratings, which we can see from that fluctuating price. So when I looked at this, I was like, okay, let's see, what does Adobe do? And if we look at what Adobe does, and maybe we can get a better look at how the company in general will perform. So they got a lot. They got their creative software. We got their cloud, Photoshop. That's something a lot of people use, and they've been introducing AI features. Illustrator, Premiere Pro for video editing. Adobe Firefly, that's their AI model of it. Adobe Express, used for creating something like social media content. Document management, Acrobat, that's what I'm familiar with when you open a file in PDF. Let's see. Yeah, so that's most of it. They do have, it seems like, some cloud. So they kind of got a wide range of things, and it's not like they're sleeping on AI. They've been busy with it. I've seen ads on their AI all the time. And if we look at their balance sheet, kind of just cherry on top, look at that. I think it's like 30 billion in assets. That's quite large. Half of that in liabilities. So total equity just chilling out there is 14 billion. That's a lot. That's it's nothing to scoff at, definitely. But this kind of gets to the point where they are poised to compete with people. They have the money to compete. So even if they're experiencing competition, I'd like to think in seeing their AI ventures that they're willing to throw their head in the ring and that they're not just going to kind of roll over and die. So currently traded at 351 and could be traded at something like, let's see here, I think we're at 515. Morningstar says 560, so a lot of room to work with there, trading at about 60% of their fair value. I would say Adobe is undervalued. I'm going to look further into the news aspect of it and what could affect their future revenues. But if I don't see it materialize, if I see that Adobe has a good chance at competing, this is a stock I'll be interested in, which is great to see because all the other ones I've been looking at are overvalued incredibly. So it's nice to see a change of pace where something is undervalued incredibly. So Adobe stock, not financial advice, of course, but something I'm looking at and I'm interested in based purely on these numbers. So let's see if the story backs it up. And in that case, maybe in my next video, I'll have some Adobe stock. But if not, we'll talk about it. So thank you for tuning in. Make sure to subscribe, like, comment any stocks you want looked at. I'd love to look at it next month. Share with your friends and tune in for the monthly recaps. So thank you for watching and take care.